you. I appreciate you. Thank you so much. Okay, so formally, a very warm welcome to the FIA Professional Indemnity webinar this morning. We've got a team joining us to run you through some highlights of the Professional Indemnity scheme. And we welcome all our members here this morning from around the country. We really appreciate you being here. And please remember, in terms of the discussion we're having today, this is not a CPD accredited event. It is an extremely important conversation regarding your own risk management strategies in your business, and in terms of legislative requirements, in terms of having PI cover, what the scheme entails, and then a really robust conversation around some claim scenarios that the team is going to lay out on the table for you to consider what could happen, where the problem areas could sit, and why it is so important that you have the right levels of cover. So welcome to Barry Taylor, our chair of the Non-Life Executive Committee, to Terry Solomon from Marsh, to Stephen Roritz and Glenn Standen from Leopard, who are joining us this morning and running the panel and the presentations. Thank you to Tulani, for all his hard work in setting up the webinars for us. So without any further ado, and to make up some time, we thank you so much. Any questions, please pop in the Q&A. And while we are doing the presentation, we will close the chat group just to avoid that being a distraction. So good morning, and thank you to the team from Marsh and Leopard sitting there together in the panel discussion. And Terry, I'm going to hand over to you.
Perfect. Good morning. Can you hear me? Just let's check that.
Great. I can hear you loud and clear.
Good. Well, good morning to you, to Lani. Good morning to everyone. Thank you so much for joining us as always. As you can see, I'm seated between two very esteemed gentlemen from Leopard. I mean, we have the real decision makers in the room, which I think is fantastic. So thank you as always to Steve. And joining us, I think for the first time, is Glenn, who's the CEO of Leopard. And yeah, we thought as the broker to the portfolio, we'd make them sing for their supper today. So it's going to be quite interactive. First 10-15 minutes, however, what I am going to do is take you through the renewal terms. So our portfolio renews, or the FIA portfolio renews with Leopard on the 1st of August every year. We start our renewal negotiations towards the end of the preceding year. We then picked up those negotiations and discussions with Leopard earlier on in the year, and now we've finalized the terms well in time for the renewal. So I'm going to spend a couple of minutes going through some of the changes, just reminding everybody what's in scope, what's out of scope, very importantly. And then what we're going to do is go into the two claims simulations, two claims examples. Today we're going to be discussing crime. You'll recall that Steve and I think last year did a professional indemnity example. So today we're going to do two crime examples. The one is first party, so what you would call fidelity or fidelity guarantee. And then the other example we're going to use is the liability to third parties following theft or fraud by an employee. Very important cover, both of them. I will say at the beginning that we've used a little bit of artistic license when it comes to the examples, and that really is just to protect, obviously, confidentiality. They are based on real claims that actually did happen, but we've embellished them a little bit just to protect the confidentiality and also just to drive home the coverage points that we're going to make. And then finally, we'll do some closing remarks. Obviously, throughout the presentation, we'll hear from Leopard. I'll be asking them some questions around, how we dealt with these claims as we go along. Okay, so I think that's sort of the agenda. I think if we get straight into it. Okay, just tell us when you can see that changing. Can you see that?
Yes.
Okay.
We can see top line, why choose Marsh.
Excellent, great.
Perfect.
So yeah, I think maybe just the sales pitch for the morning, and it won't be long. But look, I think why choose Marsh? We know that many of the people and businesses on the call today are essentially competitors of ours, and we've often had this discussion. Oh, we don't like sharing our information with Marsh. I want to just assure you that everything we do is on a confidential basis, but with the utmost transparency insofar as how we deal with your business. We are the world's #1 risk manager and insurance broker. But I think more importantly for all of you is that we have the expertise. We have to have the expertise when it comes to professional indemnity, when it comes to crime, when it comes to the D&O and the cyber. We have a dedicated, what we call FinPro, or financial and professional practice. That's 29 colleagues that deal with these classes of insurance every single day. And so you really are dealing with absolute experts in this field. And believe me, when it comes to the placement of the product and when it comes to the claims, you really want that independence and you want that expertise. So I want to just assure you again that we're acting independently, we're acting with the utmost transparency when we place your cover, and obviously when there are claims, again, we act with the utmost of integrity. Well, speaking of claims, we have a dedicated FinPro claims individual within our team. I have moved into the role of head of claims advocacy for the whole of Marsh, but I still deal with all of the FinPro claims. And so whenever of these sort of complex claims from a PI perspective come across my desk, I am there to assist and to deal with them. So we really do have dedicated resources when it comes to claims. We also have a national presence. So bear in mind, we're not just in Johannesburg, but we're also in Cape Town and we are in Durban. So we're there to assist any of our clients. If we need to do in-person meetings, we're very happy to do that because we have the depth of experience throughout the region. And then the final point I would just make is around the placement innovation. You'll see, on the next slide, we always ask the question, and we had a strat session earlier in the year with Sandra and with the exec at the FIA. And the question was asked, why should FIA members join this particular or use this particular product? Not only because it's cheaper and there is a discount on the premium, but also because we have a bespoke product where we try very hard every year to widen the scope of that cover and differentiate it from what Leopard and from other markets offer in an open market. So it really is beneficial to FIA members. So I just wanted to sort of start the presentation with that. Okay, so if we go to the coverage enhancements and just touching on again why it's so beneficial to belong to the FIA product. These are the open market versus the FIA comparison. The market remains, as you see, Leopard and Associates, and of course they write on behalf of Lombard. So I think the first good news is that there has been no changes to the base rate. Okay, and that's very important. Obviously, Leopard have caveated that to say if there are any major catastrophes in the industry, if there are any major changes between now and August, not that we're anticipating that, they always reserve the right to change the terms, but the base rate and the base deductibles remain exactly the same. So I think, Steve, maybe just on that, I know that you guys are going into a reinsurance renewal, which is 1 July, 1/7. How have those negotiations gone? How have those discussions? Are we anticipating any changes?
Yeah, so we good morning, everybody. Lovely to be with you once again. Yes, the reinsurance, we are in the market already. Our renewal is 1st of July. Currently, we don't anticipate any problems, but they reserve their position as usual to say if there is a negative movement in matters, they will be reviewing things. But we are confident that we won't have any surprises, and everything at the moment is going quite nicely. Broadly on the reinsurance side, we are starting to see, I think in the property space, some discounting starting to happen. You'll come to the D&O just now, but that is also quite a competitive space. We try, in the context of the PI for brokers and you as members of the FIA, we measure it against that particular record. And I don't think we need to move things any direction at the moment. Terry mentioned cheap. It's not really about cheap. To me, it's about making sure that we have a sustainable and that we can fulfill our promise. And our promise always is going to be protecting your reputation when a claim comes along. And I nearly said unlike other markets, perhaps, maybe that's a bit naughty, but we really do. We need to find a way to pay claims. So, I mean, Glenn, you can comment on that, but we really do challenge our team as to why we're not paying a claim. Do you want to add something to that?
Yeah, Steve, I think, good morning, everybody. And yeah, we never repudiate a claim without there being some serious, robust conversation around it. Firstly at the team level, and then it gets escalated to Steve and myself. And we often chat and say, well, why aren't we paying this claim, as opposed to how do we get out of this claim? And so it's definitely something that we work hard at.
And I think we'll show that in the examples that we speak about. So look, all things being equal, you should have an unaltered renewal, which is fantastic. What I would encourage you to do, and you'll see we make the point again later on, is because of that, relook at your limit of indemnity. Social inflation is a real thing. We are seeing attorneys' fees exponentially increase, not just by inflation. And the social inflation cost to running your business is increasing, as is the risk. So, given the rates are flat, look at perhaps quoting a higher limit as you go into renewal. So from a coverage perspective, the FIA members enjoy directors and officers insurance cover. You do have the R2.5 million automatic cover, whereas the open market doesn't. I want to just emphasize that this is not a full-blown D&O policy. In fact, it's quite limited. If you read the wording, it really is limited to breach of fiduciary duty arising out of Section 77 and 78 of the Companies Act. Now, that's very limiting. Okay, it doesn't offer things like cover in the event that there's a data breach. It doesn't offer cover in the event that the company sues the director, or in the event that employees sue the director. This is pure third parties suing the director for breach of fiduciary duty. Okay, so it's quite limiting. Obviously, looking at your own risk profile, depending on the nature of your business, you may want to consider standalone D&O cover. But I think it's important that, Leopard at least offering some cover, recognizing that we don't always have to buy these policies separately. They are giving some contingent cover. But I just want to make the point that it's certainly not full-blown directors and officers cover.
Terry, can I just add a little bit there? It is, as Terry says, quite a narrow scope of cover. I really do believe that it is now time that people should look at the D&O cover for a proper D&O policy. It's much wider than what you get at the back end of a PI policy with an endorsement. And I really do think now it's starting to become quite important. D&O cover is not just what is reflected in this in the policy. And by the way, it's not that expensive. And it really doesn't matter, even for small practices, small brokerages. We wrote a note some time ago, and maybe we should recirculate that via you, Terry, to say this is why you should think about buying D&O cover.
Yeah, and I mean, we're always happy to run a separate seminar, Sandra, if needs be, just to talk about D&O and the importance of it, because many members are PTY limited, they've got directors. Doesn't matter whether you're a large listed company or a small PDY, the liability is exactly the same. So just want to make the point, we've got the cover, but it is limited.
Yeah.
So similarly on the fidelity guarantee, yes, you've got the higher limit of 750,000 sub-limit, and you'll see in the examples that we use that that's normally wholly inadequate. It's a low limit, but again, it's contingent cover, okay, and it's not broad form. So whilst it's good to have it, you also may want to consider, given the nature of the business, particularly if you're dealing with third-party funds, for example, if you're an asset manager, or even if you're a wealth manager who sometimes holds funds on behalf of your clients, you may want to consider a commercial crime policy standalone. But again, at least you've got the contingent fidelity, and we'll go into the examples. You've got the loss of documents, which is the higher sub-limit at R1 million. You've got the regulatory expenses. Certainly where I come from, I'm seeing more and more regulators calling for these inquiries, the formal regulatory inquiries into the affairs of the business. And these are the costs associated with attending those regulatory inquiries. You have a higher sub-limit there. You've got your statutory defence costs at 2 million, which is higher than the open market. You've got your fidelity for third parties. So this is your legal liability following theft or fraud by an employee. We'll talk about an example. And there you've got 10 million sub-limit. So that's quite a high sublimit, which is good, and higher than the fidelity, certainly. And that's, again, because if you have a legal liability to your client or third party, you want that limit to be a bit higher, and you'll see it's quite a bit higher than what's available in the open market. We've got the third party cyber liability. Again, I want to emphasize this is not full-blown cyber liability insurance. Okay, this is the legal liability to third parties in the event that there is a data breach or an impersonation fraud. It's not full-blown cyber. It doesn't cover your first-party costs. It doesn't cover your business interruption, as an example. It really just is there to cover the legal liability. And you'll see that the limit sublimit is 5 million. The deductible is quite high at 250,000 rand, so it's sort of not a low deductible. But again, contingent cover, Leopard understanding that this is a risk to the business, and therefore providing some cover. And then finally, open market, you can buy 50 million, whereas as in the Leopard facility, the FIA facility, we have 100 million rand limit, which is substantially higher. So that's really good.
Can I just add one thing?
Yeah.
The fidelity extension is distinct from the dishonest act of an employee who does something dishonestly, not about stealing money or misappropriating something, but they say dishonestly that they have placed the piece of business and they haven't, by example. So that is in the main part of the policy and is subject to the main limit.
Yeah. And then just making the point on the limit of indemnity, it remains in the annual aggregate with the reinstatement, and you'll get that in the open market as well. But yeah, you do have that reinstatement, which I think is really important. Okay.
I still think the limits, though, are still too low generally. Whatever the FSCA says about limits of indemnity, it really isn't adequate. 1 million and 5 million. I've been on this hobby horse before.
Yep.
I think the minimum should now stretch out all the way up to 10 million, but I know that Terry will say, oh, even for small practice, let's start at 5. But 5 million really should be the minimum now.
I mean, the fact is, Steve, sometimes we call them laddering claims. So sometimes we'll see a PI claim, that can result in a D&O claim that simultaneously maybe has arisen out of a fraud. If you've got 1 million or 2 million and you're facing 3 separate claims, forget it, right? It's just going to be wholly inadequate. So that reassessment of your limit every year relative to the size and scope and nature of the business is really, really important. It's something the directors need to be doing every year for their business. Okay, so just moving on to the next slide and just reminding us sort of what's in scope and out of scope. It's not an exhaustive list, but I think these are the most important. So the most important is that FSP licensed entities, you're always asked to provide the proof that you've got the license, and the license must be valid at the time of binding. That's very important. Revenue not exceeding 75 million. So if your revenue exceeds 75 million, it's not that it's out of scope, it's just that it becomes a referral. Obviously, risks with no claims for the past 5 years. So if you do have claims which you notify under your proposal form, that is just a referral. Aviation, we do provide cover for aviation, provided the exposure is less than 50 million, and there are some additional questionnaires. Marine, we do provide cover for small craft and goods in transit, again, less than 50 million rand exposure. Asset managers and fund managers, as long as you're not a Cat 2A license, so you're not an actual fund manager or asset manager, cover is available under the FIA facility. We have got a number of clients who have hybrid. So for example, they'll have they are asset managers, but they don't have a Cat 2 license. They also do short term, they also do long term. It's usually a referral. Some are in scope and will be placed under facility, and some we place outside of facility in the open market. So it really just depends on the nature of the business. We do provide incidental tax advice, provided no more than 10% of the total turnover. That's something you declare in your proposal form. And then finally, the inter vivos trusts and testamentary trusts. Again, there is cover for that, provided it's a small part of the business. So, all of these are within appetite, and you'll see on the out of scope what's not in appetite insofar as FIA is concerned, and I think most of them really stand to reason, right? So if you're a bank, you're going to want a full, what we call a crime civil policy. Similarly for insurance and reinsurance companies. The retirement fund administrators, getting increasingly difficult to place the cover for these guys. Lots and lots of claims coming out of the space. Stockbrokers, derivative, forex traders, FIA members. Sorry, Leopard doesn't like crypto.
Yeah.
I think that's something that's going to come down the line, but you don't love crypto.
Insurance.
Exactly.
Reinsurers
Don't like crypto. Yep, it's available in the London market, but not here. UMAs and risk carriers, actuarial firms, and then obviously limits above 100 million rand become a referral. If you have claims, again, a referral. And I'll just make the point that a lot of these out of scope risks can be considered in the open market. Yes, it's going to cost a bit more, but you can understand where Leopard is coming from. These are just sort of out of scope risks. Any comments on that?
Yeah, I think just on the claim side, obviously, there is obligation under the policy to say things, tell us about things, including possible claims or circumstances. We're not a market that says, oh, you've had a claim, we're going to reject you. No, we don't. We try to work with you. And I think generally our loading is not as such about the premium, it's about the responsibility you take in terms of deductibles. And that it's that combination. And understanding, working with you, what went wrong, what lessons can be learned. And we would like to see you implement those changes.
Yes, Steve, just to add there, what's not really often tackled is if you've had a claim and you can tell us what you've done to prevent this going forward, what changes you've made, what risk mitigation factors you've actually put in place. If you can tell your broker that, tell us that, then that changes the way we may look at it. There may be no loading and no changes to the terms if that's the case. We're here to protect you. Incidents do happen. It's how do we know that it's not likely to happen again?
Yeah, and I think you'll see that in one of the examples that we use, how the firm took measures to fix what had happened. Okay, so just insofar as the policy wording is concerned, there have been a few changes, nothing major, but I just want to make the point. You'll see there, page 2 of 27. We've actually gone to extraordinary lengths to emphasize and highlight, exactly what you need to be aware of. I haven't seen this in any other wordings, but it says there, and I'm reading from it. It says the follow.
Important.
Yeah, it says important, right? So you can't miss it. And it says ensure that you are aware of all the policy provisions, and then it goes on to identify 11 specific policy conditions.
I'd emphasize that some important ones. We've chosen to highlight these, but they're all important.
Yeah, and the reason that we do that is you'll know that as incumbent it is on us as brokers to tell you if there's any changes. It's also equally incumbent on you as financial services providers to read your policy document and know what you are and not covered for. And so it specifically highlights outsource agreements, the systemic occurrence, which is a new exclusion under the wording, crypto activities, basic risk management and deductible, the premium, the notification of claims, cancellation rights, cyber protocols, and then the risk mitigation requirements around fidelity. So we actually spell those out for you, which I think is a new thing, that's important. From a pure change perspective, public liability, which is covered, has now just been moved as an endorsement, and I think that's just to make it clearer. The loss of documents is now referred to as data and information costs, and you'll see that it appears as an endorsement, but the scope of cover remains exactly the same. The third-party liability, which we mentioned on the earlier slide, and this is your liability following an impersonation fraud, is now sublimited to 5 million with 250,000 rand deductible, or 25% of the loss, whichever is greater. And what's more important is that there's some new cyber risk protocols that apply. Now, we're not going to cover off the third-party cyber liability claim. We'll do that in the next seminar because it is an important form of cover, but just know that the limit has slightly reduced. And that really just speaks to appetite and reinsurance. It's not a cyber policy. you know, your reinsurers, I guess, not overly excited at the fact of writing any kind of cyber in this policy. It's not what they want, but at least we've got impersonation fraud, which is increasingly a risk that we're seeing covered. You've introduced a systemic occurrence exclusion, and that just really is an occurrence which results in a claim, but over which the insured has no control. And that is force majeure, things like grid failure, pandemic.
Yeah.
Steve, I don't know if you want to comment on sort of the thinking behind that exclusion.
The thinking is, it's stuff that you're not really in control of. It affects many people all at the same time. It's a pandemic, by example. It's a total grid failure. The whole country collapses.
Yeah.
It's those kind of elements, and I encourage you to have a look at it. And certainly, you've got some comments on it. Do please revert through Terry. But it is something that is so big. It probably doesn't even really connect to the practice of being an insurance broker or an intermediary. It's those kind of elements, but that's all it is.
Yeah, and I guess you'd all agree, you know, and if you don't, please raise it. But this is nothing that other markets are not doing, right? I mean, we don't find markets covering pandemic anymore, grid failure anymore. You know, so I think that's just really contract certainty. It's not your intention to cover these sorts of
I think
events.
if you look at it really carefully, it's the stuff that you should be communicating to your customer about, saying, we don't have the balance sheet. Myself as an intermediary, or yourselves talking to the customer saying, we can't accept this risk, and this leads to a very much bigger conversation about entering into proper contracts, service, and limiting your liability in the context of saying, we can't be held liable if every single house is struck by an aeroplane and lightning all at the same time.
Yeah.
It's so big, so large, it just doesn't work.
Yeah, I mean, that's exactly it. It's just something that we can't handle, reinsurers won't handle.
Yeah.
And something that none of us really had control over, and the policy was never intended to just pick that up as a random thing. But after it's happened, everyone says, oh, well, we could get cover from our insurance broker via their policy. No, that's not the intention.
Yeah. We wish insurance policies were a guarantee, financial guarantee, but they're not. Okay, so the definition of damage has been expanded to include loss of use or control of any tangible property, etc., etc. That's just standard, and we saw that was missing, so we agreed to include expand the definition of damage. And then you'll notice that the terms member and consultant have been removed from the definition of employee. Now, cover for consultants is available, but it's available under the indemnity to others clause, and important, it's on an optional basis. Okay, so you will read that clause. It says if you want indemnity for your consultants, the policy will respond, but there may be circumstances where you really don't want to indemnify a third-party consultant. And so we leave it up to you to decide. Okay, but the words members and consultants have been taken out from employee.
You just highlight one thing, and that is if you have people operating off your FSP, be careful about how you're controlling and managing those people, because we're going to talk about fidelity risks just now, but they could in theory steal money using, and it's your FSP that is exposed.
Yeah.
The action is against you. So be careful about how you manage those people. They're not independent. They're not just doing their own thing. It affects your reputation and your FSP.
Yeah, I mean, if it's an independent consultant, you know, our advice would be A, enter into a contract with them, and B, make sure that they buy their own professional indemnity insurance, right? You don't want that risk burdened with your policy, or your policy burdened with that risk. And so separate contract, make sure that they've got professional indemnity insurance, if necessary, crime insurance, depending on what the consultancy is, and then that protects your balance sheet and your business. Okay. Yeah. Good. So if we just move on to and this is the last slide on renewal, the proposal form hasn't changed. Again, you know, we just want to reiterate, when you complete that proposal form, please, it does form the basis of the quotation. It is, as we call in legal terms, the invitation to do business. And so when you're completing it, please complete it in full to the best of your knowledge, and obviously be true and correct, because that is the information It's the first document when there is a claim. Trust me, we've seen this time and time again. It is the first document that the insurers go back to see what you said and declared in your proposal form. We're going to speak to the example of where something wasn't declared in the proposal form. We can't cover that off, right? If you know about it and you go over a renewal period and you don't report it, it's very, very difficult for us as your broker to negotiate that when it comes to a claim. So please complete it in full. Ensure that the claims question is fully and correctly answered. We always say after inquiry, so make inquiries in the business. If you're the person completing the prop, do a round robin with your senior people, including with your finance team, and make sure you're not aware of any claims or circumstances that could give rise to a claim. The other thing is there are some additional questions, as we said, for aviation, marine, asset managers. Please complete them. Sometimes we find that those businesses don't complete those questions, and then it's back and forwards, which we know you don't love, but it's something that we have to do. All right. So submit your renewal information at least 4 weeks before. Sounds like a long time, but we deal with volume. We want to make sure that we get the renewal terms to you well in time, because some of you have got internal procedures that you have to follow. You may have excos that you need to report to, etc., etc. So 4 weeks prior, don't leave it too late, because it really can prejudice you. We've seen how Murphy sometimes can happen, where we get the extension, a week into the extension, lo and behold, there's a claim, and suddenly Leopard are not overly excited to provide the renewal terms. So just put it in your calendars. It's part and parcel of you doing business. We send the renewal notifications out at least 3 months. That's what we work towards. And yes, it's a long time, so sometimes you forget about it, but make a note at least 4 weeks to give us that information. Just know that 2 consecutive unpaid debit orders will result in cancellation of the monthly payment option. So if you're paying monthly, don't miss a debit order more than twice. And remember, it's a suspensive condition that coverage is subject to the premium being paid. That's number 2 on the list of things that insurers ask for. Number 1, the proposal form. Number 2 is the policy, has the premium been paid. From a financials perspective, if you don't have 2024-25, just submit what you can, right? So the latest financials, very, very important. It's again information that the underwriters use to underwrite their risk in their system. So submit the financials as well. And then, of course, when it comes to claims, I cannot emphasize this enough, as Steve has said. We're here to help. So it is essential to report claims or circumstances which could give rise to a claim. And on the fraud side, even if you suspect that there's been fraud or dishonesty, rather call us, rather set up a call, let's have a conversation, and together we will decide whether we need to notify this or not. There is, and I want to reiterate, I'm going to ask you guys, there is no prejudice whatsoever to you if you notify a circumstance, okay, that you believe could possibly might give rise to a claim. There's no prejudice to you until that claim is actually made, right?
Yeah, 100%.
Right.
There's,
So,
we just
heard it from the horse.
Many times the claim is formally notified, and we're unsure of exactly where the claim is going to go, where it's going to end. Even then, it's not prejudice. It actually becomes quite tough, because sometimes the claim's dragged on for 2-3 years. We've never actually made any changes to the policy, and now a payment happens or something comes out. Now you want to say to the insured, okay, this claim comes from 3 years back, but now we're going to implement something different, and that's very difficult to do and often not done. So no, definitely not prejudiced up front.
Yeah, and you'll see in the example that we use, like I say, and I reiterate, we're there to help. If you don't speak to your broker and you get that expert advice and you try and go this alone and you think, well, I don't think this is going to give rise to anything, so I'm actually not going to notify it. Like, that doesn't help you from a defense perspective. Okay, so please just reach out to us when it comes to claims notification, and follow the letter of the policy, which is also important.
Yeah, bluntly, telling us about a potential claim does not impact on you. In fact, it demonstrates to us you're up to speed and you're controlling your business properly.
Correct. Good. So that was the boring part. I don't know, Sandra, if I should pause there for any questions. We can't see the questions.
Please, yes, so I will help you with that. There are a few questions related to that, which is great. I think some good questions to consider. One that Steve is definitely going to love. But let's start with, there was a question about, would errors and omissions be regarded as a deliberate act in terms of the exclusions?
No,
No,
definitely not. No, an
no.
error and omission is exactly that. It's a professional error, and it's an omission. It's yeah, absolutely. Anything intentionally done, not covered, right? So if you deliberately breach the law, if you act with gross negligence, you deliberately abuse your power, and obviously you act outside of the law insofar as your FSCA is concerned, or any law for that matter, that's not going to be covered.
But then that's not an error and omission.
It's not an error and omission. It's deliberate. Great.
Thank you. Appreciate that. And then from Michelle, she's asking, what is the reinstatement automatically included, and can it be increased or bought up? What is the reinstatement automatically included, and can it be increased or bought up? Yeah.
So a reinstatement is automatically included.
So it's an ag reinstatement, right? So it operates for the second claim.
Second claim.
Okay, so for example, if you have 5 million cover and you have a 10 million rand claim, as an example, okay, the policy will pay out 5, but it will reinstate for the second claim. So if you have more than one claim in a year, the policy will top up, but it's not for that claim. And I think that's important.
So that's another
aggregate reinstatement.
Perhaps another way of thinking about it is if you buy 10 million rand of the cover, any one claim and in the aggregate, that is the total amount we'll pay in respect of any one claim and in total for the whole policy period of 1 year. But if a reinstatement, the effect of a reinstatement is that you actually have 20 million rand in the aggregate, but 10 million any one claim. So the claim that goes through 10 million, you're on your own for that, and then you could still have 4 claims of 5 million.
Yes, claim or claims.
So think about it.
It does become quite complicated in that you could have a lot of smaller claims or 2 big claims, essentially.
But the core decision, though, Sandra, is about the adequacy of that one large claim that comes through.
Yes.
People can get carried away with reinstatements. I would prefer to have 20 million cover straight up rather than having 10 million with a reinstatement.
100%.
The reinstatement, yes, you still have to think about that 1 in 10 and 15 year matter that comes through at 50 million rand. And people are worried about the cost. Well, you're out of business if you have that. And they're concerned about deductibles. The deductibles minute relative to a really large claim.
Yeah, and Sandra, to answer the question, can you buy up the reinstatement? No, I mean the policy offers one free automatic reinstatement. We've never actually had requests to buy up reinstatement.
Yeah, I was just about to say it's not a common thing. We're hoping that no one's going to need all those reinstatements, because essentially just to add to what Steve said, 20 million aggregate is probably a better way to do it, because you get the big catastrophe claim and you have lots of cover for small claims. So that's a better way of doing it. But we've never really had a scenario where anyone's used more than a reinstatement. I don't even know.
But we've had situations where the limit was inadequate.
100%, but not the reinstatement inadequate.
Yeah.
And I think that leads very nicely into the last question on the particular renewal discussion that we're having here, is how can we determine the correct PI value to insure? Steve's favorite question.
My favorite question. We can't, there's a number of features. How big is your practice? If it's 20 million rand, you can start thinking about metrics for that. So at least 75% of that should be your limit. So you start as a base of 15 million. Then you need to look at what kind of customer base have you got? Are they all large corporate listed and multi-jurisdictional, different territories? You probably have to multiply that by 4 or 5. Is it just funeral risks that you deal with, or small investment portfolios? What is the potential repercussion? So you need to grade. For me, you need to grade your customer base and split it up. Let's say they're all general, small, commercial. Think about exposures, even a personal lines policy, or a relatively small investment advisor. There's exposures that go well beyond that 5 million mark, way beyond. earlier Terry talked about costs of litigation, that the amount does erode your limit of indemnity. I think the legal fraternity inflation, sorry if there's any lawyers online right now that are practicing, but it's literally tripled in the last 4 years. Triple. The 3,000 Rand is now 9,000 Rand, and that eats away very fast. It is an inflation component that is way out of line with normal inflation.
And you've missed the most important one, Steve, which you're always going on about, right, is risk management.
Okay.
So what are your risk management policies and processes? Like if you've done an analysis of that and you're happy with your internal controls, you know, great, then that speaks to the limit. But if you get caught out on those internal controls, that's going to speak to, again, how much insurance you buy. And I think the other thing is affordability. And you know, let's not sort of debunk that. I mean, yes, the insurance is there, and it can be expensive if you're buying at your limit. So affordability is something that you need to consider. But yeah, if you're managing your business and you're spending money on risk management and risk protocols and mitigation protocols, you shouldn't have to be buying massive limits.
But there's another little metric here that you need to think about. A lot of the businesses, people online now, have probably got their own business or part of the business. That business is probably a reasonable part of your expectation of equity and wealth. One day you may be able to sell it. If you don't have an adequate minimum indemnity, what happens to that business if you have a massive claim?
Yeah.
Suddenly, paying an extra 10 grand a month is probably fairly cheap to go from 10 million Rand to 25 million Rand, or 25 million Rand to 50 million Rand. It is, think about it like that. You destroy your business and your wealth for pennies. It doesn't ever make sense to me.
Steve, one last comment on that is the premiums don't double.
Yes,
to go from 1 million
exactly.
to 2 million. It's not double the price. It's not double the price to go from 2 to 4 or from 5 to 10. So it's normally, you know, probably in the range of 30% more kind of thing. So yes, it's not double. So those of you that have only bought 1 million Rand and never thought about buying it up, it's probably not that much to go from 1 million to 2 to 5.
Good.
Yeah. Fantastic. Thank you for that. I think that really does cover a number of questions and general things, and some of the points that you'll probably be raising in this claim scenarios as well. So I know we've got about 40 minutes.
Okay.
We need to move.
Let's go into the claims.
Fantastic stuff. So off you go. Thank you.
Okay. So the first claim example is this is basically what happened. We had short-term insurance broker, quite a decent sized business, 180 staff, 150 million Rand in turnover. So what happened here is that the CEO vets the payroll every month, or vetted the payroll every month prior to giving payment authorization. So he'd check, he'd say, yeah, that looks about right, off you go and you can pay. The financial manager, what she then subsequently did is took that and manipulated the payroll. She uploaded past employees onto the payroll, created some fictitious salaries, and paid those salaries into 3 separate bank accounts, all registered in the name of her relatives. Okay. How the fraud was discovered is that the CEO went on leave, so he wasn't around, and one of the other managers, also a shareholder of the business, was standing in for him and asked an additional couple of questions. So looked at the payroll and then said to the financial manager, well, let me look at what payments have been made. And obviously he saw some names of past employees, saw some odd-looking bank accounts, and did some investigation. Okay, at the time, the quantum was 3.5 million Rand. Investigations are ongoing. So what happened here is that the client notified the matter immediately of becoming aware. They didn't even wait for the CEO to come back from leave. Phoned the CEO, said, look, something really is up, started doing some investigations, called in the financial manager. She capitulated straight away, admitted that she had been committing this fraud. And so we notified very, very early on. We considered coverage under the Fidelity Insurance for Your Own Money and Property endorsement. Okay. Yeah, I'll just move to the next slide. Okay. And so that was, what we considered. Now, the important thing is that we had to notify within 30 days of becoming aware. That's what the policy document says, very, very importantly. Okay, within 30 days of discovery of the fraud. The fraud was also committed not more than 12 months prior to the inception. Now, this is limited cover, guys. We're seeing on a commercial crime basis that insurers are increasingly limiting the retroactive cover that's available for these crime claims. Most of the markets we deal with have got rolling retros of about 3 to 5 years. So it's not that you can discover that the fraud's been perpetrated 10 years ago and you only find out about it now. It's not necessarily covered, which means, again, from an internal control perspective, you need to be monitoring all the time from a fraud perspective, transactions that are happening. This particular one, we were able to show that the fraud had been perpetrated within 12 months. So Steve, Glenn, I want to ask a question on this. We've seen claims where some of the fraud, okay, is perpetrated within the 12 months and some of the fraud or the fraudulent transactions happen prior to that. So the question is, do you still pay the portion of the claim that's within the prior 12 months? Or do you say, because this fraud has been happening for so many years, we're actually not paying anything?
The fraud has to be committed. The component part that we were dealing with is the fraud that was committed within the scope of the policy term. And that means it has to be committed after certainly within the last 12 months and or otherwise during the policy period. Something that was done more than 12 months prior to the inception date of the policy would fall away. That component would not be covered.
So if I've committed 5 frauds starting 5 years ago, the last 5 years ago, you're only going to cover the transactions that were discovered in the policy period, but prior to which happened in the past 12 months.
Yes, but let's say the 1st of January is the date of inception of the policy. So you're talking about the fraud committed during the policy period and up to 12 months prior to the policy period. So 1st of January 2025, you go back to 1st of January 2024.
Yes.
I just emphasize that this is really nothing more than good business practice. For fraud to have been perpetrated 5 years ago and continuing every single year by the same employee, there is something bluntly wrong inside your business. And it can happen, but your controls, your protocols, your methods, all of those things are so important when it comes to this kind of issue. Even the protocols that we're going to touch on just now, they're nothing more than good business practice. You imagine if you didn't have this cover at all, what would you do? You do precisely what we were asking you to do on the policy. It's nothing more than that.
Yeah. Okay, so I think that's important to clarify, right? Because these frauds that we're seeing, we only discover these frauds some months, even years after they've been perpetrated. It's not like the fraud happens and straight away we discover it, but just be aware of that 12-month rolling retro because it is quite limiting. And again, the idea being, if it's a bigger business and you've got this exposure, then rather consider a full-blown commercial crime policy where you get longer retro periods. Okay.
So you did some bunting and marketing earlier. So I can say within the Lombard fraternity of partners and governments, we do have commercial crime concepts. So talk to them.
Okay. So when we started unpacking the claim, this is what we had to prove. And remember, the onus of proof always rests on the insured. So the first thing we had to show was that there had been employee theft or fraud. Secondly, that the employee had committed the fraud for personal financial gain. That was easy in this case because we had a confession relatively early on. Individual was in financial difficulty, obviously saw a gap and decided, she was going to give this a go. You have to report the matter to the South African police so that they can investigate. We all know what's happening in the South African police. Not great, but it is a requirement of the policy that you at least report the matter and do everything that you can, obviously, to ensure that it's being investigated. And then we get to the risk mitigation requirements. Now, to Steve's point, we had a lot of debate about this because from a broker's perspective, if you read the wording, you think, gosh, that's a lot for us to do, right? We have to make sure that there's criminal checks. We have to enforce minimum leave. We have to have a whole lot of segregation of duties, et cetera, et cetera. And on the face of it, it seems quite onerous. But I think if you unpack it and you compare it certainly to the likes of what you have to be doing anyway in running your business, these just make complete sense.
Yeah.
So it's nothing that's more onerous than we see in any other policies. And I think I want to make that point. Deal with commercial crime claims all the time. Some wordings are in fact far more onerous when it comes to commercial crime. So don't be put off by these things. Look at it as a positive. Go back to these requirements and just make sure that you're implementing them, because it's nothing difficult to implement. I mean, criminal checks. So in this particular instance, and you guys raised this as a concern straight up, you said, well, there had been no criminal checks done against this employee. We went back to the wording and it says all new employees within the policy period need to be vetted. This person had been around for 14 years. So we were able to get over that hurdle, right? And I think that speaks to what Glenn was saying earlier, is how do we pay the claim as opposed to how don't we pay the claim? You raised it as a concern. We had some negotiation back and forth and we said, no. Stick to the letter of the policy in this instance. And we managed to get over that hurdle.
This is, by the way, this is quite an interesting one. We're talking about 14 years. From my past, there was quite a large claim, and the person had been with us for many, many years as an employee, and it was a trusted person. We knew this person. It was a friend almost, and they're the ones that come along and do something silly, and you don't know what's going on in their private lives. And the default, and we talk about 30 days. Why is 30 days? You said, that sounds like onerous. No, it's not. It's about getting in fast and dealing with the issue, making sure that you can potentially collect money back from wherever it's disappeared to. It's about pension monies. It's about employment practice issues. This is about how you should be doing your business, even without insurance.
Yeah. And this is own money, right? This was their money.
Yeah, it's their own money.
Which I think, to your point, the CEO, when we interviewed him, said, look, I really trusted this individual. She's been working for me for 14 years. I would never have expected this. And the other issue that Leopard raised was the verification of the beneficiaries' details when paying by EFT. Okay. Yeah, you did raise that as a concern, but what we argued is that the CEO had actually signed this off when vetting the payroll. Now, yes, back to the original, what did the company do afterwards? They realized that they had made a mistake, that in fact, this individual had the sole ability to amend the payroll and to manipulate the payroll to add the fictitious employees. And so they stopped that, which I think is really important. And so, obviously this person has left, but they've introduced new protocol. So the payroll is checked by the CEO. It's a decent sized business, 180 individuals. He also admitted, the CEO, that sometimes he just sort of skimmed through it, looked okay, it looked about right, and then he gave the authorization. So they're spending a lot more time on payroll, vetting it, and then once that payroll is actually paid, they're doing another internal audit to make sure that it's valid. And that was the lesson learned. But the argument we had is that the CEO had in fact vetted and signed off, and therefore we felt that the verification was there. And again, you argued fair.
And Terry, the issue always is, and probably here in our own business as well, is that you get stuck in the rut of what you do. You've got your protocols, you follow them, and you keep doing, and no one actually questions those protocols until the claim happens and there's a problem.
Yeah.
Sometimes you could question where the auditor is.
Yeah.
And that obviously is a different scope of PI cover.
Yeah. So this claim was settled, and it was settled with the full policy sublimit of the 750,000 rand. There is a 25,000 rand first amount payable, which is for each. It says each financial loss. And look, investigation still ongoing for this particular client, but thankfully, not a massive claim in the sense of it's 3 odd million or 3.5 odd million rand. Investigations are still going on with SAPS. Obviously, the individual was arrested, notified to the police, etc. But all of this is for the client's own account. And luckily, they're big enough to absorb this. I think the issue is, if you're a small business, can you absorb 3.5 million rand and even more because of legal costs, etc. So again, just reiterating that 750,000 rand, it's there, but it's a low limit.
Yeah.
And I think just again, the AOL agreement of loss was signed within 6 months of being notified. And I think to Leopard's credit, you know, they saw that this was a valid claim. They weren't going to mess around waiting for quantum to be proved, etc., etc. They said, look, we're in for the 750. Here's the agreement of loss. Let's move on. And I think, again, you know, that was great, because we have insurers who say, no, we're going to wait until you've proven this full loss before we actually decide. In this case, you knew you were in for the 750, so rather not sort of just wait. Okay, so that's an example, good example of the policy in action. This one's a little bit different. So what we had here is we had Insured Y. This is a small financial advisory firm. They really mostly do financial advice. As you can see, 12 staff, 20 million odd rand turnover. So what happened here is that one of the financial advisors worked in cahoots with an employee in finance. So he went to a client, in fact, a couple of clients, but he went to this particular client, and he managed to convince this client that they should invest 2.3 million rand in a Sanlam investment portfolio. And he said, my colleague in finance will be in touch with you, you know, to iron out all the details. So what happened is the individual in finance wrote to the client. Bear in mind, a lot of the communications in this particular matter were over WhatsApp between the client advisor and the client. Now, that doesn't help, and you'll see a little bit later on. So what happened is the financial person reaches out to the client and says, here's a Nedbank account. Please make payment of the 2.3 million rand into the Nedbank account, and then obviously we'll make payment into the Sanlam account. Now, you know, again, because everybody was in cahoots, or these two individuals were in cahoots, difficult to pick up that fraud that was happening behind the scenes. But nonetheless, the client makes the payment into the Nedbank account, and a couple of weeks go by, doesn't get any response from the financial advisor to say, you know, where are my policy documents? I've got no confirmation that the investment has been made at Sanlam. Nothing from Sanlam. What is going on? Nothing gets done. Eventually gets escalated to the CEO. CEO says, all right, let me do some investigation. And lo and behold, they found that the Nedbank account, of course, is fictitious. It was in the name of the employee concerned. This particular client has an ABSA account. Now, again, when you make investments, Sanlam investments, you don't actually pay into your broker's account. You normally pay directly into the Sanlam account. So, you know, should the client ask some more questions? Absolutely. But the client said this financial advisor had been with him for many years, and that word trusted the financial advisor. Everything looked legitimate. And lo and behold, there's now a letter of demand from the client claiming vicarious liability, so third-party liability to that client. Okay, upon investigation, later on we found out that two more clients then came forward and obviously, you know, realized that the employee in cahoots had stolen more funds, and that claim now sits at around 11 million rand. So it escalated. Okay, so when it came to policy response, we obviously notified the claim when it came in, and we considered policy response under the Fidelity Insurance for Third-Party Money and Property. That's the endorsement, the end of the policy. You know that there's a limit of 10 million rand. There's a 25,000 rand excess, stated in the schedule, or stated in the schedule, whichever is greater. Right. So this was a difficult one, because straight off the bat, we were dealing with a late notification. The client only notified us 8 months after they became aware of the matter. They said that they were investigating. The CEO said that they had called in investigators. We didn't have much information to go on by way of investigators, so they didn't employ a third-party forensic auditor, as an example. They were doing investigations. You know, we tried really hard to negotiate the late notification, but in conjunction with all the other things, as you'll see, insofar as the policy terms and conditions, and particular clause 4.3, you know, the client didn't adhere to any of these things. And so it became really, really difficult for us to argue the late notification as well as non-adherence to all the policy terms and conditions. Okay, so 8 months, and I guess this is a question for you, Steve, or Glenn. You know, what's reasonable, right? We have to be reasonable. Sometimes the 30 days is quite onerous, I think, okay, but it's not hard and fast. And I think if they're mitigating circumstances, you will be reasonable. What's reasonable? Why wasn't 8 months reasonable?
Well, I think the problem is the time has taken.
Yeah.
So if you think about the prejudice to actually dealing with it, that's the primary issue. 8 months, I think, is well out of line. Had they had everything else perfect, and we probably would have been a little more forgiving.
Yeah.
But the reality here is that it was basically open the door, let anybody in. We can't write, we try to do plain language policy, but we can't say, if you're an idiot, we're not going to cover you. But that was it. I mean, there was absolutely no control about anything, and that ultimately is.
Yeah, and I think the nail in the coffin for us, so to speak, was the fact that we had gone over a renewal period. So we went over a renewal, and in the proposal form, where it says, are you aware of any claims circumstances, the client said, no, we're not. In the meantime, there was supposedly investigating this fraud. And I think that's what killed it for us. Like, we had to capitulate that if you go over a renewal and you're not notifying that even that you're aware of something, it's seriously difficult for us to argue.
And I think the first step for a notification is you don't have to tell us exactly how many transactions took place, how much has been stolen. The first notification is essentially the client has reported that his investment wasn't placed. We actually think there's some fraud going on in our office.
Straight away.
And this is our first notification to you. We'll come back to you in a couple of days. And then we will, as brokers and insurers, jump in and say, give us this, give us that. How can we assist? And as long as you've done that, your claim is notified. If we sit back and do nothing and let you carry on doing your own thing, well, then that will be our problem and not yours. But that's a simple notification like that is sufficient initially.
So I think just to, and again, just to elaborate on that. So if you looked at clause 4.3, there were no criminal checks performed for the employee. This particular financial employee, I think, had been there over 2 or 3 years. It was relatively new. And yes, we can argue during the policy period, new employees. Okay, but Leopard said, look, this person's relatively new to the business. There were no employee checks or criminal checks ever performed. There was no compulsory leave policy in place for this employee, which I think is really important. There were no procedures in place to monitor the creation of new payees, and the employee was simply able to email the client and say, please put money in our net bank account. There were no checks and balances around that. And yes, we did argue that it was really difficult because there was collusion with the financial advisor. But the truth is the financial advisor has no business with finance, right? There should be strong segregation between a financial advisor and what goes on in the financial part of the business. And so there were really no procedures to monitor that or to check. And so we had really difficulty getting over that. And then the final point, which again, I think really didn't help us, another nail in the coffin, was the fact that a lot of and deliberately so, right, when we unpacked it, is that the financial advisor, was WhatsApping their client, his client quite a lot. Don't worry, everything's under control. As agreed, this is what we're going to do. You'll be hearing from the financial, from our finance officer, etc., etc. WhatsApps, forget it, right? They're just not going to help you. If there's no proper record of advice, the Leopard are going to run for the hills as they did in this one.
Yeah.
Comments about that, guys?
Yeah. I mean, with the best will in the world, it's almost, we have responsibilities to our principal as well. We can't just arbitrarily pay anything. The terms are there for a particular reason. It reflects your business practice. And that's when you discover these things. If you haven't got insurance, sure, go ahead and proceed. But if you have got insurance, like anything, tell us about it. I mean, it's not as if we're ogres, but having not told us about it, and then we discovered that in fact everything was open season. Nothing was done in terms of, oh, let's change the bank account from this to this via WhatsApp. I mean, it's almost incredulous in the current world that you do something like this.
So look, we have a client now who And I guess one of the questions was, didn't you feel bad? Because here we've got a client, it's a small client, right? 12 employees, small business. They are facing an 11 million rand lawsuit. I don't think that they've got any defenses, to be perfectly honest. They've got to go ahead and try and defend it, or maybe settle the matter. But the fact is they've got no insurance. It might mean the end of this business. We don't know. They didn't do it on purpose,
no.
Right? So they didn't set out deliberately to ignore the policy terms and conditions or have no risk management protocol in the business. Obviously, it wasn't done intentionally. But the fact is the insurance contract is an insurance contract, and we tried our best, but we weren't successful. So, yeah, I mean.
Yeah, I think, Terry, where there's one little thing that went wrong, or there was an error or an omission, to use previous words and whatever, and something didn't quite go here according to plan, we're most certainly willing to look at it and consider it. When literally every aspect of this claim becomes a problem, from the late notification to the non-compliance to the lack of correspondence, which often helps us to help you. And when none of that exists, it's very difficult.
As I said right from the beginning, our culture and the way Leopard likes to do things is to find a way to pay a claim. It's impossible on this one. We couldn't find any reason to pay a claim. Policy language put to one side, saying, how can we help you? We just can't in this particular case. It was, as I said, where's the exclusion saying we won't cover if you're an idiot? Can't say that in the policy wording, though.
No, you can't. Okay. So I think we'll just move on to the last slide and some closing comments from me and obviously from Steve and Glenn, and then open it up to some questions, Sandra. But I think the closing comments really just encapsulate what we've been speaking about and reiterate what we've been speaking about. The PI policy it's a critical risk mitigation, reputational management, and risk transfer tool. Like, you need to give it the attention that it deserves. We know, right? I always tell the story. My husband is a wealth manager, and every year his policy comes up for renewal, and every year he's late. It's with you guys, by the way.
That's not.
It is. And every year, I go completely mental because the broker phones me and says, "Guess what? It's time for renewal," and you're late again. There's nearly a divorce in the family. But it's such an important risk transfer tool. Give it the attention that it deserves. I can't underestimate that or overstate that. The limits of indemnity we've spoken about. We've spoken a lot about social inflation. The rates are unaltered, which means there's no reason why you can't get a quote for a higher limit. It's not going to cost you double. It's just, look at it. It's good business practice to consider what the policy covers and then relook at your limits. I mean, Steve, I think 10 million is probably high. Maybe 5 million is a minimum that you should be looking at, given the size and nature of your business. Again, familiarize yourself with the policy terms and conditions. We've gone to great lengths in the wording, as you can see. Important. Read the policy wording. If you're not clear on anything under that policy wording, phone us, call us. We'll have a discussion. We'll take you through what what your concerns are. So I think that's very important. Consider limiting the liability in your TOE. All the bigger brokers do it. Your lawyers do it. Your accountants do it. Your auditors do it. There's no reason. You are a professional services firm. Consider in your terms of engagement limiting your liability. I assure you, you're not going to lose clients as a result of that. And if you do, I'm not sure that they were clients that you sort of want in the first place. Okay. Renew the policy on time. We've spoken about considering separate crime and cyber. What you have in place is really basic contingent cover. So just consider that. And then claim circumstances, always err on the side of caution and speak to us. Just call us. That's what we're there for.
I think just to emphasize what Terry's saying, that contract between you for services and your customer, it exists verbally, whether we like it or not. Condense it into something in writing, and at the very least, say very specifically what you are not going to do. I want to touch on one other little thing that's been popping up recently, and that is the communication between you and the insurer of record. The contract certainty there, and we've got a couple of claims going on at the moment where there is some doubt about whether the insurer and the broker placing the business with the insurer were absolutely clear in terms of a meeting of minds that said this is what we're doing. So it's really important, and the big brokers do this all the time. There's a very clear document going to the insurer saying, please quote on this basis. The insurer provides a quote back. This sounds so simple, but it goes wrong. Provides a quote back. You then communicate to your customer, and the customer says, yes, I want that cover. You then replicate that, and it connects to the quotation that was given to you by the insurer. What we're finding is that there's sometimes a conversation going on as opposed to the formality of a quote. Then something's issued, and the broker goes, no, wait, hang on a second. No, please change this. But there was no clear meeting of minds, and that creates a big problem, contract certainty.
It's a good point.
I would love to see more deliberate and very detailed and clear, a proper record between you and the insurers to what you've agreed, quote, and acceptance. That's the foundation of a contract. Clear communication to the customer, absolutely critical.
Yeah. I mean, we've just settled that on the PI side. It was a claim, a Marsh claim. So our client, we had sent our client a policy document, renewal terms, and the market had provided the renewal terms but failed to bring our attention to a warranty in the policy. And they had just sort of slipped this warranty into the actual wording which they attached to the quote. And we were successful in arguing that they too have a responsibility, the insurer, to notify us of any major changes, and we actually won that matter. So, you know, your client doesn't care, your client's going to still sue you and look to you, but in the background, you may have some very valid defenses where the insurer also has duties and responsibilities.
Yeah, so it's not, don't rely on just a collection of emails and possibly WhatsApp messages these days saying, oh, but we agreed this. No, condense it down into clear documentation to the insurer saying you've agreed to quote on this basis. This is what it is. This is what we're putting you on risk for. Please say yes, accept, as opposed to, oh yeah, that's fine, no problem. Here's a WhatsApp. See you on Saturday.
Yeah.
And Steve, it's not about also for us repudiating or not paying claims. It's in the scenario you're busy telling us about is we're trying to help the client. The client is very unhappy that they're being held liable, but actually the correspondence and the backup paperwork just isn't there. And the legal guys are throwing it back at us saying, I don't care what you guys say. The contract never came into force. There's not a piece of paper that says that. There's no clarity, and so clarity and that documentation is vitally important.
Yeah, that's a good point. Good. So Sandra, maybe we'll stop there. I see we've sort of taken the liberty of saying that the next session will cover cyber impersonation events. That's just us saying, taking the liberty. But those are important because I think those are happening pretty every day. We're dealing with these impersonation frauds every single day. They're getting more sophisticated. So we thought that would be a good one to unpack next time.
Can we say the next session will cover cyber impersonation event and also a proper sensible limit of indemnity, contract certainty.
It's never going to stop.
It'll go along with it.
We'll find dates. Our members certainly want to hear all about this, so we will find the dates to put this in for everybody. We do have a couple of questions that have come through. So if this was an anonymous user, but they asked, can you give us an example of gross negligence, sort of a claim that you have repudiated due to gross negligence?
Yeah, I mean, while you're thinking of the example, the good old adage, ask 10 lawyers the difference between gross negligence, you'll get 10 different answers. I mean, the precedent is that gross negligence borders on deliberate conduct.
Yes.
Yeah.
It's so if there is an intention to breach the regulation or an intention to commit, to breach your fiduciary duties, that would be regarded as gross negligence. So it always depends on the facts of the claim. But if there was a deliberate intent, we would regard that as gross negligence.
I like, just to clarify, I like the example of I'm sitting at my desk on the 10th floor and I'm really cross about something, and I throw my computer out the window. It's very negligent, very stupid. I did it deliberately, but I just, at a moment of anger, I throw it out the window. Unfortunately for me, it goes all the way down and hits somebody on the head. Now, that I did not intend to hurt that person. It is borderline gross negligence. But if I look down and I see a bunch of people and I deliberately throw it down, then I think we're very clearly into the scope of gross negligence. And it hits somebody on the head, as opposed to I've made a mistake. I didn't place the policy properly. But on another occasion, I just said, stop it. I'm not going to worry about placing the policy. Now you're talking about seriously gross negligence, and the word deliberate comes into play.
It literally needs to have the word deliberate with it almost.
Yeah.
You battle otherwise to prove or even get away with gross
Like
negligence.
just a gross dereliction of duty.
Yeah.
You know, you knew you had to do something, you couldn't be bothered to do it, and that results in okay, that's grossly negligent. So yeah, always depends on the facts of the particular claim.
Yeah.
I think proof would be extremely hard in those circumstances.
It is. I mean, we even if we do have a deliberate act exclusion. I don't think we've ever applied it. I don't think we've ever applied it. So the action against the insured, sometimes they use the word, you were negligent, breach of duty, you didn't care, you were grossly negligent.
Yeah, and I think, Sandra, we've moved away from negligence-based policies when it comes to professional indemnity. We rather refer to legal liability, right? There's a difference in law between negligence and legal liability. We don't like negligence because you've got to prove negligence and gross negligence. So we don't actually like to see those words. And in your service level agreements with your clients, also don't be using those sorts of words. Obviously you can't contract out of negligence or fraud. So that must always be included in your TOEs. You can't contract out of that. But we've seen wordings where you're only liable for gross negligence. That sort of doesn't fly anymore. Our policy should respond to any legal liability on your part.
Yeah. Which is what we do.
Thank you. Then I think this is a question that probably Craig has asked, but I think a lot of people will be having this in their head as well. Are or will underwriters consider including crypto activities under authorized licenses when they are authorized to operate in that field? Because there are more and more requests from FSPs that have received license to operate under that category.
Yeah,
So,
as we speak, we're working on a product specifically for the crypto licensed firms, businesses. It's quite complex, and it may be that we have to issue a separate policy just for this space. It's unclear in some instances. Are you advising people to buy crypto? Exactly why are you doing that? Why did you tell that 98-year-old this is a great idea, punt everything into a crypto? What is the value of a cryptocurrency? How do you do that? If you think about the auditing world, they go along and they try to value something for balance sheet purposes. And it's probably more to do with ready for sale, and it's a spot price. But tomorrow it could be half the number or double the number. So there are issues around that. So we would have, with the product we're thinking about, is it won't cover the market movement. We're not interested in the market movement. If you are sufficiently aware of what kind of investment you're making into crypto, well, that's fine. You're taking the risk that it could be naught tomorrow or double the following day, or something in between. That's your problem. That's the investor's issue. So it's the crypto advisors need to be very clear about that. And I think we're close to having a product that will help this particular category. But it'll be focused on the advice.
Yeah.
That's really all it's about, not the value of the stuff.
Not the fluctuations.
And obviously the fraud.
Yeah.
That's the easier side. Someone managed to steal something.
Yeah, that's certainly a market that I think is still fairly scary, and fluctuations all over the show. So actually understand where you're heading in that direction. So we look forward to watching the space, to what you come out with. We've had a question from Mike, and I think this is something that possibly could also be included in a further session, or maybe even as an article or a specific reference to our members. So he was talking about, querying, so number of claims in the past 3 years, sort of highest incident, most common causes of a claim. So it's almost like a Q&A around the PI and the policies and what the incidents are, and helping us create awareness, which is what these webinars are all about. Even to those who are diligent in their approach. And I just love the way he used that wording in there, because yes, no matter how hard you try to tick all the right boxes, I think we are human, errors happen, and this is exactly why you have all these covers in place. So I think that's something, Terry, I mean, we'd be very keen to look at covering those.
So look, we do collate that data, and as you know, we report to the FIA board on a quarterly basis, and we sort of give some data around number of claims, nature of claims, so to the extent that we can unpack that, absolutely, as long as it's on an anonymous basis.
Yeah.
But we do collate that data, and Leopard have excellent data around their claims. So yeah, to the extent you guys are happy to share that, we're happy to present it as well.
We may need to go beyond what the FIA looks like. I mean, we've had done for the last couple of years, we've had a 25 million rand and a 40 million rand minor detail, and where people have tried to be diligent, but caught out when the legal beagles come to it and actually look at it saying contract certainty. If you look at the wider book of Leopard, we've certainly got one floating around at 100 million, and the number of claims probably relative to the size of our book has stayed relatively calm. No, calm's the wrong word. Consistent.
Come on, Steve, taking the 100 million rand claim out on the FIA,
yes,
so it's not. The FIA is looking good, Governor.
We're talking to a lot of brokers. We're talking to a lot of brokers. What happens, and I was a broker for 23 years, so I do understand that you say, okay, well, here's the claims experience. We take out the big ones. Now it doesn't look so good. It doesn't look so bad. Doesn't look so bad. I played that game too.
The unique circumstances that you want to take out of your aggregates. There aren't any other questions, and I think that's tuned to what you've covered here, and you've really outlined it beautifully, and that there are going to be additional events. I think we did have asking us, and this is just from our side, just to cover, we will be sending out copies of the presentation, and as always, we share our webinars via our YouTube channel. So for members who perhaps you need to look through it again, or you want to share it with a colleague, please, we encourage you to do that. So it will be available from that perspective on the YouTube channel, probably within the next 5 working days, somewhere around there as well. But those were the questions. And I mean, we are spot on the money. It's 11:29, which is fantastic. But final words from you in terms of your experiences and any messages you want to leave with the members.
Yeah, just again to reiterate, from a Marsh perspective, we're here to help. If you're uncertain of anything, please reach out to us. If there's a claim, please reach out to us. We're there to help. It's what you pay us commission to do, and so please, we're there for you.
Yeah, I think from probably speaking of both of us, that brokers face a different world right now, and it's tough. It really, you do understand it's really tough. The membership needs to understand that their customer expectation is sometimes way higher than what you promise to deliver. And it's that gap that I think needs to get managed a little more carefully. That the broker, and you've got your businesses, you employ people, you've got some wealth building up. protect your baby. PI cover is only one small part of it. The rest is your own risk management, your own protocols, doing things well, clear communication between you and the insurer and the insured, and yeah, this is how you protect yourself.
We keep talking about in our ideal world, in our ideal world, all things follow simple processes and stuff like that. We understand that just always happen. It's impossible. But if there's one thing you can do, just try and do the basics well. That's it.
Yeah.
Right. Thank you again for your time and for the effort in sharing this with all our members. And we look forward to our next event. And please, those members who are not currently on the scheme or haven't looked at your PI cover in a while, please take into consideration all the stuff that's shared with you. Reach out to us as the FIA team, as well as Terry and her team, and let's see what we can do to assist you and make sure that you are comfortable with where you have bought your limits of cover. And that you are protecting your baby, as Steve said, all that investment you've put in, time and effort. But thank you for joining us today. Thank you, much appreciated for the time, and thank you, members. Enjoy the rest of your week.
Indeed. Thanks, everyone.
Thank you.
Bye-bye.
Bye.
Thank you, Tulani.